At a time when foreign investors have been on a selling spree across most emerging markets, including India, flows from mutual funds via the systematic investment plan route and directly into equities by retail investors have supported the markets. However, according to analysts, the headwinds, inflation, rising interest rates, and an upturn in the real estate cycle may dent flows into equities as an asset class going ahead. According to Jefferies, a record over $60 billion retail inflow through mutual funds and direct into domestic equity over the last 12 months has helped absorb heavy foreign selling. But they believe retail inflows cannot be taken for granted. As trailing one-year returns drop towards zero in another 3 to 4 weeks, the pace of retail inflows can reduce. History shows that a sustained property market boom and higher market volatility can also impact flows, says Mahesh Nandarkar of Jefferies. FIIs so far this year sold securities worth $22 billion. However, this has been met by a similar $23 billion purchase by DIIs. Data shows that the domestic participation has broadened over the last 12 months, with mutual funds retail equity folio count and SIP accounts up by 29% and 42% respectively. Retail investors are also turning to direct stock purchases. The number of Demat accounts has gone up 63% year-on-year. Brokerage Jefferies estimates an inflow of $36 billion directly into stocks from retail investors over the last 2 years. Thus far in calendar year 2022, the S&P BSE Sensex and the Nifty 50 have slipped around 7% each. The fall has been less as compared to their global peers such as DJIA, Nasdaq, S&P 500, Kospi, Hang Seng, Shanghai Composite, CAC 40 and DAX, which have lost 12% to 28% during this period. This outperformance of the Indian markets, even in the correction phase, was possible due to strong participation in equities by retail and mutual funds, analysts said. Besides Jefferies, Jigar Shah of MIB Securities India too believes that the retail participation could shrink going ahead as the RBI hikes rates and more investment avenues open up as interest rates go up.
What I feel is that so far the April data which has come out for mutual funds does not really suggest any major change in the behavior of the investors, especially the equity inflow which is taking place through the SIP is very, very strong. Having said that, it would be very interesting to see the May and June data, because in the June 1st or 2nd week, we will have another policy decision, and possibly around that time market could crack quite sharply. So at that point of time, we have to see how is the behavior of the investors, and at the same time, we would also see increase in the interest rate, which would enable investors an avenue which was not there till now. Therefore, there could be also a swing into the debt mutual funds or the fixed income products, fixed deposits, bonds. That itself could lead to another outflow, which can hurt the equity markets. So we'll have to see these 2 months and the data, how the investors respond to that.
Over the past decade, strong retail inflows have coincided with declining or low deposit rates, according to analysts at Jefferies, who expect the deposit rates to go above the 7% level with a lag even if the RBI were to hike rates. Low property price inflation over the past decade has supported strong equity inflows. Property prices have started rising now and there is room for property market upturn, says Mahesh Nandarkar of Jefferies. Nandarkar adds the current surge in housing demand is end-user driven, but a sustained upturn will likely pull in property investors as well. This could negatively impact equity flows, he says. On Thursday, the markets are likely to remain choppy in a range ahead of the F&O expiry for May series. Stock-specific action, however, will continue.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.